There was a company too big for anyone to understand. It made the light bulb, the jet engine, the power plant. Every home in the country had its mark somewhere. Its name sat on the Dow for over a century. And then quietly the market threw it away. Stay with me, because the warning hides in plain sight. This is how the most valuable firm on earth fell. The company was General Electric, and it began with Edison. Thomas Edison founded its earliest piece in the year 1892. For 100 years it built the machinery of modern life. It lit cities, powered hospitals, and pushed aircraft skyward. By the year 2000 it was worth $600 billion. No company on the planet was valued more highly. Its chief executive was a man named Jack Welch. Welch ran the company for 20 hard, relentless years. They called him, with awe, the manager of the century. He grew the firm into a sprawling conglomerate. It made appliances, locomotives, and television networks. It made medical scanners and the engines under your plane. And quietly, it built something far harder to see. Inside the empire grew a giant bank called GE Capital. On paper, it was a small lending arm of the firm. In truth, it became one of the largest banks in America. It lent money for cars, homes, jets, and whole companies. At its peak, it held $500 billion in assets. It grew through a long string of restless acquisitions. Each year, the empire bought yet more businesses to absorb. Here is the part that should make you uneasy. Almost half the company's profit came from this finance arm. It was a factory of money bolted onto a factory of steel. Investors loved GE because its earnings rose so smoothly. Every quarter, the profit landed almost exactly on target. Real businesses are never that smooth, and that was the clue. Manufacturing is lumpy. Sales rise and fall with the world. Yet GE's numbers glided upward like a calm escalator. How do you make a messy empire look so perfectly tidy? The answer lived inside the opaque world of GE Capital. A finance arm can shift profits between the years. It can sell an asset early to plug a weak quarter. It can delay a loss until a brighter season arrives. This practice has a polite name: earnings management. It is legal at the edges and dangerous at the center. It does not invent profit. It only borrows it forward. Every smooth quarter quietly steals from a future one, and the future eventually sends its bill. Now hold that idea, because here is your real lesson. Never buy a business you cannot actually explain. If the profit is too smooth, ask exactly where it comes from. A great brand is not the same as a great stock. GE was a household name in every kitchen in America. That fame made investors stop asking hard questions. They trusted the name and skipped reading the footnotes. The footnotes were where the real story was buried. Walk through it slowly, the way Graham would have. Benjamin Graham taught us to read the whole balance sheet. He warned against companies you simply cannot decode. GE's accounts ran to hundreds of dense, tangled pages. Even seasoned analysts admitted they could not follow them. When the experts cannot understand it, that is the answer. An investment you cannot explain is not an investment. It is a hope wearing the costume of a company. Now let us watch the smooth machine begin to crack. Jack Welch handed the company over in the year 2001. His successor was a careful man named Jeffrey Immelt. Immelt inherited an empire that looked golden from outside, but the finance arm had grown into a hidden monster. GE Capital borrowed short and lent long to feed itself. That is a fragile bridge over a very deep river. It works only while lenders keep handing over fresh cash. Then in 2008, the whole credit market froze solid. Banks everywhere stopped lending to one another overnight. Suddenly, GE could not roll over its mountain of debt. The most valuable company on earth nearly ran out of cash. Think about that. An icon, 1 week from the cliff. It survived only by begging for emergency rescue money. A famous investor wired $3 billion to save it. The government had to backstop its enormous debts too. The smooth golden machine had been a fragile illusion. And the dividend, the symbol of its strength, was next. For decades, GE paid a dividend you could set a clock by. Retirees built their whole income around that promise. A dividend should be paid from real, repeatable profit. GE's was increasingly paid from selling off its own limbs. That is not income. That is slow self-cannibalism. In 2009, the company slashed its dividend hard. It was the first deep cut in over 7 decades. Income investors who trusted the name were stunned. Here is the lesson, and it will protect your own money. A dividend is only as real as the profit beneath it. Only. Always ask where the cash to pay you truly comes from. If a firm sells assets to fund its dividend, beware. That is a company quietly eating itself to feed you. After the crisis, GE limped on for nearly a decade. Immelt tried to shrink the dangerous finance arm down. He sold off most of GE Capital piece by piece, but the easy profits of the boom years were gone. The smooth earnings that dazzled investors vanished too. Without the finance engine, the real business looked thin. The industrial core alone could not carry the giant. Then came the most symbolic blow of the entire story. Recall that GE had sat on the Dow Jones since 1896. It was the very last original member still listed. For 110 years it stood on that index. It had outlasted every other company it began beside. Then in 2018, the keepers of the index acted. They removed General Electric from the Dow entirely. The last original icon was simply taken off the board. A drugstore chain took its place on the famous list. Imagine the most valuable company falling that far. Its stock had lost over $400 billion in value. Retirement accounts across the country were quietly gutted. A single share is now a small fraction of its old worth. The lesson is carved into every one of those losses. Bigness is not the same thing as safety. A long history does not guarantee a long future. And a famous name can hide a fragile, hollow core. Let us gather everything into rules you can actually use. First, understand what you own all the way down. If a business is too complex to explain, do not buy it. Complexity is often where bad news goes to hide. Second, treat suspiciously smooth earnings as a warning. Real companies are bumpy. Reality is never that neat. Third, never confuse a beloved brand with a sound stock. The product can be wonderful while the shares are doomed. Fourth, demand that dividends come from real profit. Cash paid from selling the furniture cannot last. And fifth, when you cannot understand the books, walk away. There is no prize for owning a beautiful mystery. Graham would say the same in his dry, patient voice. Buy what you can value, avoid what you cannot. The intelligent investor is not the one who knows the most. It is the one who admits clearly what he does not know. General Electric was not brought down by bad luck alone. It was brought down by a story too smooth to be true, by a finance arm no outsider could ever fully see, by earnings polished until they hid the real shape, and by a name so trusted that no one looked underneath. The most valuable company on earth became a cautionary tale. Its fall is now a lesson printed in every loss it caused. So carry these questions into every company you study. Can I explain in one plain breath how it makes money? Are the earnings honestly rough or suspiciously smooth? Is the dividend paid from profit or from selling the walls? Do I trust the name or do I trust the numbers? Answer those and you will never own the next GE blind. The company that once seemed too big to ever fall. The company too big for anyone to truly understand. That was exactly the reason it finally came down. Understand what you own or you do not really own it. If this was useful, the next episode covers margin of safety. Subscribe and keep learning to read what others ignore.